Hello, everyone. I'm Raj Changadoo. This is Property Investing 2.0, and my guest today is Akhil Mair. Akhil is the managing director of Our Mortgage Broker, a specialist property finance brokerage. He deals with a range of financial services from traditional buy-to-let options to bespoke commercial and residential solutions. He has worked with a number of high-profile property investors within the UK. We're lucky to have him. Akhil, hello and welcome. How are you?
Thank you, Raj, having me on board. I'm very well. We're under a lot of pressure, but we're working at it. What can I say?
I bet your industry is extremely busy right now. We'll jump into that in a little bit, but as you know, we want to do a pretty much straightforward Q&A session as much as we can. We want to give investors an idea of what to look for in those buy-to-let deals when it comes from a mortgage standpoint, what lenders look for in terms of criteria, and as you just alluded to, what the current market looks like right now. But
Sure.
So if you're ready, I'm ready, and we'll just jump straight into it if that's okay.
Let's go for it.
Cool. So first and foremost, it's an obvious question, but I think it's still one that's important, and that is, why these days do we actually need a specialist mortgage broker within our power team? Because there's comparison sites online. People can go direct to some lenders. Why do we need a mortgage broker?
Yeah, no, Rod, it's a great question. And this comes up weekly, if not daily, with a number of our new clients predominantly. And the reason why I think you need a specialist mortgage broker, whether you're entering the market as a first-time buyer or a specialist buy-to-let portfolio landlord, for example, it's imperative that you do engage with a specialist and reputable mortgage brokerage. And there's a number of reasons why, and the few that I'd probably want to touch upon is, one is, they do that job day in, day out. You know, as mortgage brokers, we're speaking to lenders, we're speaking to underwriters on a daily basis. So we know how lenders work, we know what their criteria looks like, we know what documents that they're going to require for any type of mortgage that we're applying for. The other thing is time, and Raj, you do what you do for a living, you do it very well. You may not know our industry well, and you may not have time. So here it's key is that, I always say to our clients, you go and find the property. Leave us to take care of the finance headache for you. You do what you do best, find the property or do your day job. Leave the finance to us, because that's what we do for a living, That's what we do for a living, and we get paid for supporting our clients in finding solutions. So time, expertise, and the other thing I would say is the complexity of the market, A lot of our clients have complex incomes. They may have more than one type of income. They may have rental income. They might be portfolio landlords. And as you touched upon, a lot of the high street lenders are shying away from complex lending cases. And a lot of properties out there are complex in their own nature. And for example, you might have a 6-bedroom HMO. You might want to invest in a limited company. You might be a high rate taxpayer. You might own 20 properties. A lot of the high street lenders will shy away from that for those obvious reasons. Whereas where we sit in the specialist mortgage brokerage arena, we've got access to a wide range of lenders, and they all do great and innovative stuff. They offer lots of different types of products, I should say. So whereas the average guy works for example, PC World or Curry's, knows their main bank where they get their salary paid, and the other high street lenders that sit next door. Whereas we work with, as I said, a range of lenders, and we don't just work with the high street, we work with all types of lenders. So we like to think that we know what we're doing. We know that not one size fits all. If the client has been turned away from the high street, there usually is, or there may be an alternative. So with the high street, yes, we'll always endeavour to try to place your case at the high street, because that's where the prime low rates are. However, not as I said, not all cases fit. One size fits all, I should say, with all clients. So it's matchmaking. So we like to call ourselves Sailor Black.
Okay, I like that. That's a reference that not everyone's going to get depending on their age. But
I used that last night on Clubhouse. I don't know if any of your listeners are on it, but we just joined Clubhouse yesterday. So we mentioned that one on Clubhouse yesterday. It went down quite well, so I thought I'd throw that in the mix.
Good. Well, to be fair, if it's on Clubhouse and it's working, then that's another topic altogether. Clubhouse, very new, sweeping the world right now. Clubhouse, isn't it?
Yeah, no, it is great. I think the attention is quite much there. Long may it continue, but it's great. It's great.
Cool. No, and what you've just said in terms of why we need a mortgage specialist, yeah, I can't agree with more. And I'm sure most professional investors would feel exactly the same. And everyone else is going to figure out why we need them based on the rest of the questions that we're going to dive into as well. So let's move on. You touched on it at the start in terms of the current market and that you've got a lot of pressure on you right now. We're in a national lockdown still.
Mm-hmm.
We've got the vaccines rolling out, which is great, but we still got stamp duty, holiday, and furlough kind of swinging in the wind. We don't know if it's going to be extended or not. How is all this affecting the mortgage market right now?
Yeah, no, it's a great question. There's a lot of uncertainty in the market, I would say. We've got stamp duty, which is due to be ending on the 31st of March. We've got furlough the following month. There's a lot of uncertainty in the market, and it's not great. It's not nice for those end consumers, and it's not nice for us in the firing line, if you like, and trying to help our clients over the line. But what we endeavour to do first and foremost is work with our clients. We need to understand what we do is ask them. We understand what their agenda is, what their objectives are, and meet their deadlines where possible. Now, what I always say is we need to work with our clients, but again, work with the professional teams that surround that transaction. That's including the surveyor, including the lender, including the conveyancer. So we've all got to be in sync with one another, understand the objective, and the objective is to find the mortgage for the client and get them the keys by a certain date. So it's key and it's imperative that we all work together. And the only way of doing that is by communicating. We've got multi-uses at the moment of communication, email, telephone, and so on. But it's been a challenge, I would say, especially during the first lockdown predominantly, where there was a lot of unease with people working from home. They didn't have the equipment from working from home and so on. So there was a lot of issues then, and a lot of valuations weren't being carried out. But to be honest with you, the lenders have done phenomenal. Over the last sort of 9-10 months, they've done a phenomenal job. They've managed their backlogs very well, I would say. And to be honest with you, we're at a level now. We're at pre-COVID. The SLAs are down, lenders are responsive, valuers are responsive. So we're heading in the right direction. But as you said, yes, we've got a lot of deadlines to meet at the moment, especially around the stamp duty and furlough as well.
Yeah, I mean, is there a little bit of holding your breath moment? Have you seen maybe just temporarily a slowdown in applications because maybe people are just thinking, well, I'll wait to see what happens? And then on the other hand, there's applications that are probably getting rushed through, right? They just want to get them through as quickly as possible. I mean, what are your thoughts on that?
Yeah, no, from our perspective, the pedal is fully down. All our clients want to buy. They still want to buy. They still want to remortgage. And they're still looking for investment properties or home movers. So from our side, no, it's all go at the moment. And we are managing expectations from our clients' perspective, and we are putting that disclaimer in to say, we can potentially get you a mortgage offer within the time frame required. But again, we've still got the other obstacle in with regards to the conveyancer. They've got to apply for local searches. They've got to do the legality works and work with the other side. And again, it's an education piece. Now, not everyone understands the whole process of obtaining a mortgage. However, what we do as mortgage brokers and what we should all do in all our professional arenas is guide our client, manage expectations, explain to them the timelines and what the processes look like.
Yeah, no, I completely agree from that perspective. And I mean, it's not all doom and gloom. Like you said, people are still looking for those buy-to-let deals, and lending is as cheap as it's going to be, basically. So if you're finding those deals, now's a great time to get them through from that perspective, if you know you found the right deal for yourself. So let's get into a couple of those buy-to-let questions that
Sure.
investors need to be aware of. And I want to start with, there's some people listening to the podcast and listening to other people who might not own their home yet. So They're thinking, well, investing's not for me. But can you get a buy-to-let if you don't own your own home?
Yeah, no, great question. And there's loads of myths around. You have to own your main residence in order to get into the buy-to-let landlord space. And that's not true. That is genuinely not true. Now, as I said, I touched on in the beginning, there's a whole host of lenders out there that all do weird and wonderful things. So as brokers, what we do is we understand the backstory. Clients situation where it is now. Are they living with family? Are they renting? Are they employed? Are they self-employed? Once we gather the facts from the background and we understand what the client's expectations are, we'll work with them. We'll matchmake them with the right lender. So going back to your question around they're living with their parents, for example, they've saved up a load of cash through their income, or they may have been gifted some money from family or inherited money. Now, the client, it's not always necessary that the client needs to own their main residence or they have any intention of owning their main residence, because they might be happy living with their parents and their siblings. Nothing wrong with that. Now, you can go and buy your buy-to-let as your first purchase. So your class is a first-time buyer and first-time landlord. Now, most lenders do want you to own your main residence or have already owned a buy-to-let before you buy a second buy-to-let. So if, for example, let's use that simple example of you living with your parents, you've saved up a load of cash and you want to go buy your first buy-to-let. You are classed as a first-time buyer, first-time landlord, which is not a problem. Now, what the client wants to ensure is, first things first, because buy-to-let's an unregulated transaction, the key here is to understand that the client has no intention of moving into that property. And how they will initially analyze it and make sure they're not is doing a quick income verification. So say, for example, we've got a client, Joe Bloggs, who works for Deutsche Bank, for example. His income is 50,000 per annum. He wants to buy his first buy-to-let. He lives in London, sorry. He works for Deutsche Bank in London. He wants to buy his first buy-to-let in Liverpool. I'll pick on Liverpool because I'm a huge supporter. All right? Yeah. So he wants to buy his first buy-to-let in Liverpool. Now, with an income of 50,000, giving you a rough guide, if he wanted to buy his first main residence, he'd probably be applicable for a mortgage of circa around 250,000. Now, the lender is satisfied that his income multiples allow him to borrow up to 250,000. Now, our client Joe Bloggs, for example, now wants to buy a buy-to-let as his first purchase for 100,000 in Liverpool. Now, if he wanted to make that his main residence, he can quite easily do it because the affordability is there. So the lender needs to assess that first. Is it affordable on a residential basis? Because the risk for the lender is he's a first-time buyer, first-time landlord. He's got no experience. So the first thing they need to qualify is, has he intentions to live there? Now, if he lives and works in London, there's no chance he's going to go and live in a property in Liverpool because it's 200 miles away, right? Or so. So that qualifies that. Second of all, if he's looking to buy a buy-to-let, let's say 5 miles down the road from where he lives and works, there's going to be a bit more focus around that to say, okay, why is he buying a buy-to-let as an investment, as a first purchase, and why is he not buying it as a main residence? And as we said, he might be happy with his family. He has no intentions to move out. Got a large family. He's living with his parents. He's living in a large family home. So we can qualify it from that perspective. So we can either use the income and geographically how far it is from where he lives and works to qualify it, or we can substantiate it from he's got enough income to buy this property as a buy-to-let or on a residential mortgage. Does that make sense?
Yeah, no, absolutely. And I think that's a great analogy that you've used in terms of the London, because that's, there's one example where people still live at home and they think, yeah, I'm happy at home and I want to buy my first buy-to-let. But a great example is you just live in an area where you have to be there. You're in the hustle and bustle, you're in London, that's where your job is. Yeah. But it doesn't mean you can't make your money work for you somewhere else, and I think that's a great example that you've used there. You did touch on income multiples in terms of determining what amount of mortgage you can get. I think that's something for people. You used a rule of thumb there. What was it? 4.5 times income? Typically?
So in the height of lending, a lot of lenders were doing 5 times. When COVID came in last year, a lot of lenders pulled back the loan to income ratio. So typically it's always been 5 times. Now lenders have shied away saying it's 5 times. It's more done on income and affordability, which it genuinely is, and it still is. However, we're in 2021. A lot of lenders have now come back into that market. They're back at the 90% loan to values. Lenders are offering 5 times, 5.5 times, even 6 times income. Now, there is different variances in that, and some lenders want you to be in a professional capacity. Are you a solicitor, are you a doctor, dentist, barrister, and so on. There you're going to benefit from the higher multiples, 5 times, 5.5 times, 6 times even, which we've seen. Or you might have a 6-figure salary, which then allows you to multiply that income by 5, 5.5, and 6 times. So all lenders do different weird and wonderful things. But again, it's very much subjective to what your job description is, your occupation, what level of salary you've got, and where you are in the journey. So if you're on 100,000 salary, you work as a conveyancer for a large law firm, for example, in central London, there's a good chance that we're able to get you between a 5 times and 6 times income, which is great for those guys that are either trying to get on the ladder or looking to move home to get into a bigger property. Now, it's not just about the income multiple that you need to be concerned about as for example, as an applicant trying to get a mortgage. Lenders are acute and they want to know what your expenses look like. So we need to factor in what's your credit card balances, if there are any remaining. Do you have a PCP on a car finance, for example? Do you have any HPs? Do you have any unsecured loans? So we will factor this into an affordability check. Now, the great thing is all the lenders offer an affordability calculator on the website, and this is predominantly around the residential space that we're talking about, so owner-occupiers. So when we're speaking to our clients for the first time, we'd go on a fact-finding journey. When did you start at the employer? How long have you been there for? What's your gross salary? Do you get any bonuses, any commissions, any overtimes? We'll put that information onto the affordability calculator with numerous lenders. We'll also plug in information about any overheads and expenses. So do you pay for student loans, car loans, personal loans, as I touched on? And at the end, the system will generate a mortgage that they can consider up to. It's virtually on point, and it's still very much subjective to do a full underwriting and credit scoring with the lender. But that gives us a good indication on the level of borrowing that we can hopefully get for our clients.
No, I think that's great to start getting people thinking about some of the criteria that they look for in terms of you as the investor.
Yeah.
And what do they consider from the actual property standpoint? So if you're looking at a standard buy-to-let, what are some of the criteria that they're looking for in the actual property itself?
Okay, so if we're talking about buy-to-lets now, so the key here is, as I said, there's tons of lenders in the market, which is great. We're actually overwhelmed with products. We're overwhelmed with the choice of lenders, which is great, but sometimes it's not great because we're sort of, as I said, we're overwhelmed. We're spoiled on that side. But it's actually a good thing, as I said, because a lot of clients are doing weird and wonderful things to properties. They're converting, for example, a 3-bedroom house to a 5-bed HMO. They're converting offices, for example, to residential apartments. So there's lenders for every single type of project or every type of property out there. With regards to matchmaking a lender with a type of property, that is very much, again, bespoke to the property itself. If, for example, we're looking at an ex-local authority property with deck access, with a flat roof, for example, there's going to be a certain lender or certain cluster of lenders that will look to consider lending to that type of property. But going back to the question around finding the lender for the type of property, again, when we're doing our fact finding with our client, we have to understand not just about their personal circumstances, but about the property itself. If it's a HMO, how many kitchens are in the property? If it's, as I said, it's a HMO, how many kitchens, how many lounges? Are they self-contained units? Are they got locks on doors? Is it a HMO in an Article 4 area? There's so much to go on. And clients may want a commercial valuation. Some clients want a bricks and mortar valuation. Can we get a commercial valuation? There's lots of sticking points. And these are the conversations that we have with our clients from inception, so we erode any issues going forward. Do you know what I mean?
Yeah, no, you've touched on a few things, a few avenues we can go down there. One in particular that we keep coming back to is HMOs. So,
yeah,
it's a specialist strategy, HMOs or service accommodation. Do lenders' experience comes into mind? Do they look, is that a big factor for them? Do they look for that type of experience?
Most lenders do want you to have a buy-to-let. So in the background, I have owned one for at least 3 to 6 months. However, there are a couple of lenders out there, as long as you're a homeowner. So if you own your main residence and you're entering the buy-to-let investment space for the first time, there are a couple of lenders out there that offer HMO products for a first-time landlord, which is amazing. But again, they want to ensure that they're lending responsibly, lending to the right client, lending to the client with, as I said, being a homeowner and having enough surplus income in the background to ensure that they can carry any voids. And another thing that lenders do is, because of the PRA rules, they've now brought in, over the last few years, they've brought in stress testing on portfolios or on rental calculations, whether you are a portfolio landlord or not. There's stress testing that comes about as well.
We'll come on to actually stress testing in a minute. Actually, that was
Sure.
another question that I was going to say. But just sticking on this for a second,
Hmm.
is there a way around it? And my mind's going towards, okay, I don't have this experience in this particular field, but if I have a few rent to rents, does that classify as experience? Because at the end of the day, you're managing these properties, you know how to look after them. Does joint venturing with another person who has got a couple count as experience? I'm just trying to think about
Yeah.
the people who are looking to do these strategies for the first time.
Sure. So for your listeners that are listening out there, unfortunately, lender won't consider if you've got a load of rent to rent in the background, or you've done JVs, unless you can evidence and prove that you've physically owned a property. And the best way of proving that you've owned a property is having your name at the land registry, either previously or currently. That's the only way you become an experienced landlord. But as we touched on, if you are a homeowner and you want to move into the buy-to-let space, you don't need to have owned one previously. You can buy a property. And whether you live, as we touched on earlier, if you are living with parents, you can become a first-time buyer, first-time landlord at the same time. But yeah, rent to rent, anything like that, yeah, it's not classed as experience, unfortunately, in the lender's eyes.
No, that's certainly important for people to know. That it seems like, okay, at some point you are going to get pushed down to either buying your own residence or buying a buy to let to start that experience really going.
Yeah, no, I think it's great for those guys and girls out there that are a bit short of money at the moment to get themselves a mortgage currently. And I think rent to rent, managing my properties and landlords, and speaking with agents is great. Education in this business is key. And I say to myself every day, every day is a school day. If we don't push ourselves, we're not learning, right? So there's always something to learn. And for those viewers out there that are listening, it's not bleak. And the reason why I say that is there's definitely opportunity out there for you. But just in the mortgage space and in the institutional space, you have to have what they call skin in the game. If you're buying something for 100,000, for example, let's just keep numbers easy. To get into the buy-to-let space, you'll need at least 25% deposit. So that's 25,000. You can make that up by saving the money from your surplus employment income. It could be, as I said, gifted from your parents and siblings. So there's many ways of doing it. But again, if you're unsure, if you've got any questions, pick up the phone to us, drop us an email. We'd be happy to help you or steer you in the right direction, because, I was once upon a time a first-time buyer and a first-time landlord. So I understand it from both sides of the fence. And I think that's another imperative thing is you've got to work with the right people, one that you can get along with, you can trust, but fundamentally that's someone that's been there and done it, And I think it's key that whoever your viewers engage with, speak to people that understand today's market. And I hear it a lot. I've been in the industry for 20 years. That's all well and good, but the problem with it, 20 years ago was a totally different industry where we are now. So no offense to those guys that have been in the game for 20 years, and no doubt that'll bring a lot of experience to the game. But fundamentally, the industry's changed. The mortgage industry has totally changed for the greater. And I've been investing since the year 2005. So that's 15 years, and I've seen pre-Lehman's, post-Lehman's, and now we're going through COVID. So there's many obstacles. But for those viewers out there, please do contact us, and we'll be delighted to help you.
Yeah, well, like you said, even if you're an experienced investor and you haven't bought anything in 10 years, well, that says one thing. But even if you're an experienced investor and you own 10 or 20 properties,
Mm-hmm.
you're seeing how many applications a year, over how many years. It's just it's a different ball game altogether, and the computer says yes or no response going direct isn't always going to work. So yeah, I think that's a no-brainer to definitely be looking at your mortgage specialist for advice and to get an idea of your options.
Yeah, the other thing I want to touch on is a good point, Raj, you made there is it's not necessarily not all lenders have that same system. The computer says no, sorry, goodbye. A lot of the lenders now in the market actually offer a manual-based approach. So as mortgage brokers, we've got not as such like the back line, if you like, into lenders. We can speak to most of the underwriters and say, we've got this scenario, Joe Bloggs, this is his background, this is the current situation, this is his intentions. We can talk them through the scenario, talk them about the background, because entering things in the system and having a manual human approach is two different things. So the beauty about today's market is there's a lot of lenders out there they actually want us to speak to them prior to putting a case in to them, because we can then they can actually ask for an exception. They can speak to the underwriter on our behalf if we're not speaking to them already, maybe get an exception. Some lenders want a minimum income of 25,000, but he or she's income is 23,999. So they're £1,001 away. So there's loads of exceptions. But again, it's always on a case by case basis. But that's why I love the market where it is now. We're sport by choice, but fundamentally we've got access and we've got reach to the right people to get things over the line. Whereas just as it was 3-4 years ago, it wasn't possible. So it's a great time to invest in property. And, I can talk about real estate and investing in the UK all day long. I love it. And I think it's a great place to be.
Moving on, actually, you talked about stress testing. And that is a criteria that people need to be aware of if they're not already. So tell us how that works exactly.
Okay. So stress testing, let's tell you what stress testing is. Stress testing has been put in to cover any voids. So what happens is, if tomorrow the Bank of England hike their rates from 0.1 tomorrow to 5%, can the client weather that storm? Has that client got enough income to cover that mortgage if tomorrow the rates spiked at 5%? So now lenders are having this stress testing and putting in place. It's actually a good thing. And the reason why I say it's a good thing, it's actually a better thing from the client's perspective, because it goes to show that they're buying the right asset at the right price on day one. Because ultimately, where you make your money ultimately is on day one. Anything you make on top of that is because of your own doing. If you've gone through permitted development, you've added planning permission, you've added bedrooms, I always call that the Brucey bonus on top. But where you make your money fundamentally is on day one. And that we talk about below market value deals and so on. But fundamentally, it's all about where you buy the profit, I think, is always on day one. With regards to stress testing, every lender has their own ways of stress testing portfolios, but there is a generic rule of thumb that every lender and every client and every broker has to adhere to ensure it's fit for purpose. There's two ways of owning buy-to-let properties, fundamentally. It's one in your personal name and one's in a limited company. If you're looking to buy a property in your personal name, there's two ways of stress testing it, and it's dependent on your tax banding, so whether you're a basic rate taxpayer or a high rate taxpayer. If you're a low rate taxpayer, and that's evidenced by way of salary slips or tax returns, self-assessment tax returns, the lender will assess your income typically at 125% of the rental income, and then they stress it at either 5%, which is a notional rate, or a 5.5% typically. If you're a high rate taxpayer, it's usually 145% at 5% or 5.5%. If you buy property in a limited company wrapper, Joe Bloggs Limited, a lot of lenders have adopted, rather than basing the stress test at your income tax bracket at 125 or 145, they have a flat rate of 125 if you buy in a limited company. So it's advantageous from a lending perspective for the client to borrow more in a limited company. However, there is a difference in rates. So borrowing in a limited company fundamentally allows you to borrow more, usually, compared to owning a property and borrowing in a personal name because of those tax brackets. But as I said, there is a difference. You pay for what you get. So borrowing a limited company typically is around 3% or more. If you borrow in your personal name in a buy-to-let space, it's typically 2% or so. So there is around a 1% difference in rates borrowing in a personal name and a limited company. But do speak to those viewers out there that are considering buying property in a limited company. Just bear in mind, as I said, the 1% or so difference in rates. Plus, if you buy in a limited company tomorrow, you may then need to engage with an accountant, which then will mean that you've got an accountancy fee to pay. But there are also tax benefits potentially as well buying in a limited company. Now, I'm no tax advisor, so a bit of a disclaimer here. Please, before you buy in a limited company, do engage with an accountant, understand the benefits for that client buying in a limited company and the disadvantages and the costs as well. Now, what we do at our mortgage broker is we always provide our clients with two options, especially for those that are coming into the market for the first time, or even those that have typically always bought in a personal name and they now want to buy in a limited company because of the Section 24 rules that came into play 3 years ago. So we'll always supply our clients with two options, as I said, personal name personal name buy-to-let and a limited company option, so they can compare apples and apples together. And I think that's imperative. Now, we've got to be transparent and impartial as mortgage brokers, so we always do the right thing, and we'll always give them two options to compare, and we'll talk them through it. And if there is a lot of complexity around income, or they're large portfolio landlords, we surround ourselves with a power team as well. So we surround ourselves with property accountants, and no offense to the accountant that you might engage with or that does your regular books might not be property savvy. So ask them the question, but again, go and compare apples and apples with a property tax accountant, because he or she might be able to give you a different angle on investing in a limited company. So I always put it out there. Please do engage with a property tax accountant before investing in limited company, because it might not be the right thing, or might not be the right timing for you in your property journey. But again, from our perspective, we'll always offer two alternatives for the client to digest.
No, I think that's great, what you've shared there, Akhil. And like you said about going to your property tax accountant, it's so important, because it's like going to your GP for brain surgery. It's like sometimes it's just a generic approach. They know a lot about a lot of things, but when you really want to dive in deep and understand something more, I definitely think you got to go to the right people sometimes. You mentioned again, buying in a limited company versus buying in personal names and Section 24 and what that's done in the past. But people need to understand that just because you're buying in a limited company doesn't mean you've got limited liability, right? I know that's an obvious thing to say, but I think we should at least address that, and so people know. I guess it's personal guarantees, right, to the company. How does that work exactly?
Yeah, no, 100%. You hit the nail on the head. I have a lot of clients say, "Oh, if I buy my limited company, I'm not liable for the debt." And I'm like, no, it's a limited company is a wrapper for the ownership. It's a wrapper, but ultimately the lender is going to look at you as a human. One, to underwrite and see if you're worthy to get the loan out, and two, you are liable for the debt. And buying in a limited company means a bit of extra paperwork when it comes to conveyancing, and there's a personal guarantee that you would have to sign independently with another conveyancer as well. So the debt does lie with that director and shareholder or shareholders of that limited company. So unfortunately, it doesn't die with you; it remains part of your estate. So that's definitely correct.
No, it's good to know, and it's unfortunate for the people who thought otherwise. But
no, definitely not.
Let's move on. I want to touch on Build-to-Rent. That's something that a lot of investors are looking at these days in certain areas of the country, but exposure on the site, that comes up from a lender's point of view. So just take an example of someone wants to build 8 flats, and afterwards they want to hold them back, remortgage them on buy-to-lets. Mm-hmm. Can they get all those buy-to-lets with one lender, or do they have to go to multiple lenders?
Right. Okay. Great question. So before the client sets out building those 8 flats, for example, let's use your example there, they need to engage with a bank, a mortgage broker, first and foremost. Now, if, for example, Raj, you wanted to come to me and say, Akhil, I've got this parcel of land, I've got planning permission, I've done this before, and I want to build 8 flats. Here's my power team, here's my JCT contractor, and so on. First of all, have you got money to build the flats? So do you have development finance to, for example, build it? Let's assume that you've built it. Let's just skip that. We're not going to talk about bridging and development for the moment. You've built the flats. Now you're looking for the exit. The exit strategy is always what we do is thought out at the beginning of the build. Now, with regards to 8 flats, 2 questions we ask. Are all 8 flats on one single freehold title? Are all 8 flats on individual leases? Now, there's no right or wrong. It's what the developer's chosen to do. Now, let's go with option 1. They've kept all 8 flats on one single freehold title. All lenders, and especially this will be a lender that in the specialist space, right? So specialist doesn't necessarily mean high rates, crazy rates, crazy fees. It just means they've got the appetite for that type of lending, that type of project, that type of property. So let's assume that we've got 8 flats on one single freehold title. There's a variety of lenders out there that will offer what we call a multi-unit freehold block mortgage. So 8 flats on one single freehold title. What that means is it's one single mortgage application, one single valuation, one single set of conveyancing. The mortgage application would go in. It would say the block value is £1 million. The rental income combination of all 8 flats is, let's call it £8,000 a month, 96,000 per annum. We'll use that stress testing calculation. So let's say you own it in the limited company, 125%, either at the 2-year fixed rate, which they'll use a notional at 5%, for example, or if you borrow in a 5-year fixed rate, it's done at the pay rate. And we'll probably touch back on that, actually. It's quite a valid point there. So it's one mortgage. If, for example, during the conveyancing, you've created 8 single titles, 8 single leases for each of those individual flats because you were unsure whether you're going to retain all those flats or potentially selling 50% of it. You might want to sell 50% and retain 50% and vice versa and so on. We'd then have to apply for 8 separate mortgages because ultimately they're all self-contained and they've all got their own legal titles. Most lenders don't like taking on that much of exposure because they've got 8 flats, 8 single freehold title flats, all under one roof. It's just too much exposure. So every lender's different. Some will take 25% exposure, some will take 50, some will take 2 of the 4, some will take 4 of the 8, but in different metrics as percentages or number of units. So they'll have a different combination or criteria. The benefit to owning those properties on single titles is the value has to go and value each individual flat. So each individual flat usually means a higher GDV, which is the gross development value. So you'd probably get more value out of owning 8 individual flats rather than having a block of 8 flats. Does that make sense?
Yeah.
So the benefit of borrowing, there's pros and cons on both. There's no right or wrong, I would say. So we've got one mortgage application for 8 flats on one title, which means you can't sell one flat because it's all under one roof and one mortgage. Whereas if you have got 8 separate leases, 8 separate mortgages, you can buy and sell those properties as and when you wish. And the likelihood, the value, the aggregated value on 8 separate individual flats is going to be a lot higher than 8 flats on one title. So there's a benefit there. There's no right or wrong, but it's all about the developer or the developer understanding what the exit strategy is. And that's what we allude to at the beginning. Now, again, the intention might have been to sell the flats pre-COVID. COVID turned up and the market might have flattened. Well, we know it definitely didn't flatten because right now it's on fire in a good way. So there's no right or wrong. If there is 8 flats, it's 8 separate mortgages. Some lenders will take on all flats. Obviously, the more flats under one roof on separate titles means you might need to go to a commercial lender. So the rate of borrowing can get slightly more expensive. But again, it's all subject to the property, the amount of exposure and the risk.
Yeah, no, that's interesting. And like you said about COVID, I'm sure like a lot of developers, I certainly did, at least phone up a mortgage broker and go, right, okay, worst comes to worst, do I have to put these on buy-to-lets?
Yeah.
I'm sure a lot of people were thankful that hasn't been the case. It's gone the opposite way, but it's thinking about those multiple exits up front like you were talking about there. And the exposure thing is pretty bizarre. Does that count in terms of, this is just something that popped into my head, like even if they have exposure of a couple of flats in that block, but across the road they have another 6 flats, so that makes up to the 8. Does it count for the whole area, or is it just the site?
It's just the site. No, it's a great question. It is just the site, and it makes no sense because the lender might have exposure, as you said, down the road, and it might be the same postcode. But what they can concentrate on is actually on that parcel of land. What's their exposure? But some will do 2 out of the 8. Some will do all 8. Again, it's horses for courses. And it's dependent on the client's appetite, whether he's happy to pay those sort of rates or does he want to do. Some clients actually want to have their risk or their exposure with a number of lenders. Yeah, and the other thing you've got to touch on there is some lenders have a max exposure as well in terms of mortgage value. So some lenders allow you to have up to 20 mortgages or up to 2 million, whatever comes first. So if there's a lot of things that we have to do as mortgage brokers, is, it's not just, throw them at just choose any lender and it'll fit. There's lots and lots of criteria. So it's a lot of juggling. It's a lot of fun and games, and lenders are doing, as I said, weird and wacky things, which is great. But they do change the goalposts very, very often. So you've got to keep your finger on the pulse.
Well, what you said there just spurred another thought in my head. It reminds me of '08 when you said, some investors might want to have mortgages with different lenders. And
Yeah.
08's an example of that. If someone wants to call the loan in, well, you don't want the loan called in on all 8 of those flats necessarily. Different lenders might react differently. So that's just food for thought for people as well, just to consider. Last couple of questions. I want to be mindful of time. I want to move on to valuations and remortgaging, because a lot of investors naturally want to recycle their cash, try and get it out where they can. And one thing they might have to contend with is the 6-month rule. So tell us a little bit more about that and how it works and how lenders use it.
Perfect. So it's a hot topic at the moment. So what Raj is alluding to there, I think you are, Raj, is buying a property in January, refurbing it in February, refinancing it in March, or selling it in April, for example, a combination of all that. Now, you're totally right with regards to the 6-month rule. Now, I'll keep it short and sweet. If you buy a property at an auction via a bridging loan in January for 100,000, in February you spend £10,000 on it to bring it into a great quality, market standard, street standard, and now it's valued at 200,000, you can refinance within that 6-month rule. There is no 6-month rule. You can refinance at the 6 months. If you've inherited the property and you've inherited the property and you want to refinance the property within 6 months, that's also applicable and it can be done. If you bought a property in cash in January, you want to refinance and pull out your cash in March because you found another property that you want to buy, or you've added value to the property, there is an opportunity for you to refinance within the 6 months. Now, all lenders have their own bespoke criteria. Some lenders will offer the refinance at the market value, the uplift value, today's value, rather than the purchase price. Some lenders will offer you refinancing within 6 months, but at the purchase price. So as mortgage brokers, we need to understand when it was purchased. Can they evidence that they've spent money on the property? How much have they spent on the property? And what's today's market value that they're expecting? If they can evidence it, it gives us more firearm, if you like, to go and find the right lender. But again, for those clients that are looking to do that, what they call the BRR strategy, it's key to understand what the exit is. But again, you need to engage, especially if you're looking for that finance, either to buy it at the inception or just at the exit. Because not necessarily everyone needs to come to us on day one. Some people have the cash, who have the appetite to buy outright, but then they need to come to us to take out the cash in order for them to go shopping again. So it's key that they engage with us on day one so they can understand what's the flavor of the month with lenders. And as I said, lenders change their goalpost weekly, if not daily at the moment. So it's key that if you are looking to recycle your cash, and ultimately, like all investors, is to refinance at usually the top end of the loan to value, 75, even 80% now, you've got to understand and work to the parameters of the lender. And as I said, you've got to speak to the mortgage broker on day one, tell them your expectations, tell them your goals, tell them the timeframes that you're working to, and then what we'll do is set you up. So for example, if you're buying a property and you need funding on it and it's unmortgageable, you may need to go down either the cash route or a bridging finance route. The great thing about bridging is there's a lot of lenders out there that offer a bridge to let product. And in short, what that means is one lender, one valuation, 2 products. So you'll get a bridging loan to acquire the property. You'll even get money to do the refurbishment, depending on the level of refurbishment. And the valuer on day one who comes in, assesses the property to say, yes, I will lend you on a bridging loan first, will give you a valuation at the end at the same time. So you get 2 valuations, today's value and what tomorrow looks like, because you're going to provide them with a schedule of works. You can do that with one lender, or you can go to one bridging finance lender, acquire the property, use your own cash to do the refurbishment. And then we can use a third-party lender to exit it onto a HMO mortgage, for example, or even just a regular buy-to-let mortgage. So there's lots of great strategies out there, But my advice is to anybody out there is engage with a mortgage broker. That's one that's experienced, one that's done it so many times, and it's all about telling them what your expectations are, what your timeframes look like, and ultimately what your goals are.
No, I think that's a great explanation for the rule and for how it works. I mean, why was the rule brought in exactly anyway in the first place?
So there was a catastrophe. There was a bit of money laundering going on, from my memory, in the 80s. So there's a few building sites that got basically robbed. There was a bit of people selling that they sold a property, but they didn't, and it never got tracked on land registry. So ultimately, there is a 6-month rule out there, but there is ways that you can get around it, but as long as you can evidence it in different means. So get in touch with us for those that are looking to refinance within 6 months. There is ways of doing it, but we just need to know a bit more.
Right, fair enough. And last question for me today is commercial valuations. You touched on it at the very start. Again, this is something investors like to do, to be able to buy a property perhaps on bricks and mortar valuation. They refurb it, they increase those rents, and they're looking to refinance based on the commercial valuation on the yield of the property. So I hope I've got that right. You're the expert here, but I'm just trying to do a generalization of it. And what are some of the things that investors need to be aware of in terms of how they're going to go about this? And are there any rules of thumbs that they can work towards?
Yeah, no, it's a great question. And what savvy investors always want to do is refinance, not based on the bricks and mortar valuation, but as you said correctly, refinance on the commercial yielding valuation. And sometimes that discrepancy is huge. And as landlords and investors, that's what they want. They want to refinance on the commercial yield rather than bricks and mortar. Now, fundamentally, there's a few things that investors need to ensure that they have done, and they've ticked these boxes to ensure they get a commercial yielding valuation rather than a bricks and mortar, because they might scupper the deal. They might not be able to pull out as much as cash as they needed to or expected to. First things first is you need to pick the right lender. You know, people forget this. Pick the right lender that, first of all, offers the product that you're looking to get. Second of all, the lender needs to instruct the right surveyor to apply for a commercial valuation. Not a single AST dwelling valuation, but potentially a 6-bedroom HMO yielding valuation. So fundamentally, that's the key here. The right lender and the lender instructing the right valuation. Now, to ensure you do get a commercial valuation, it's got to smell and look like a commercial property. It's got to have that abundance in that property. And the best way of doing it and the best way of looking at it is, can this 6-bedroom property be turned into a single family home tomorrow? If the answer is no, there's a good chance you're going to be able to get a commercial valuation. Now, your viewers might say, well, how do you know that? The best ways of doing it is, does it have self-contained rooms? Is there kitchenettes in the rooms? Does it have locks on doors? Has it gone over and beyond with regards to health and safety and regulation? Does it have fire doors? Does it have different entry points? Does it have 2 kitchens, 2 lounges? See, these type of fundamentals can't be changed into a single family home overnight. There's a very good chance that you'll get a commercial valuation. The other fundamental one is, does your property sit in an Article 4 area? Now, for those that don't know what an Article 4 area is, and I'm sure a lot of your viewers do, it's an area that can't accept any further HMOs, for example, within that area. So there's a good chance that you'll be able to apply for a commercial valuation because your 6-bed HMO sits in an Article 4 area, which means your neighbour next door can't convert his 3-bed semi-detached house into a 6-bed HMO without applying for planning permission. There's lots and lots of cities and towns in and around the country that now have an Article 4 wrapper, if you like, around it, which means you cannot turn your property into a HMO, for example, without full planning being consented. So that gives the advantage to the developer that owns that property to expect a commercial valuation. So for those that are looking to enter that commercial space, expecting a commercial valuation, pick on an area that hasn't got an Article 4 area today, but that is going to have an Article 4 area tomorrow. The key there is, I think it's Birmingham that's having an Article 4 direction put in, I think as of June 2021. Or I think it was last year, I'm not sure which way around it was, but councils give you a heads up which areas are going to have an Article 4 banding on it. So for those areas, those are the areas you need to get into today, because if you miss that boat, you're not going to be able to enter that boat without full planning. That's first and foremost. And two, have the right lender on board that's actually going to offer you a HMO mortgage, for example, and they're going to instruct a commercial valuation. And make sure if you are converting your property to a HMO, go the full distance, make it look like a HMO, make it feel like a HMO, and make sure you go spend the extra buck on it, that you can't turn the property back in, because ultimately, you spend more on day one, you'll get more out on the back end. And fundamentally, people have changed the way that they're living. Living standards have changed. A lot of people are working from home. Is that going to change? Are people going to move back to offices? I don't know, actually. So if you're going to convert your properties to HMOs, have workspace, have balcony access, make sure you've got a green area, you've got gardens, you've got car parking, because that way you're going to ensure that you've got a good tenancy, they're going to stay for longer and pay you top dollar as well. So some people shy away from adding better fixtures and fittings. I would go the whole distance, go the whole hog, if you've got the appetite and the experience and know-how, because you've got a better chance of securing better tenants, better paying tenants, longer tenancies, and ultimately a commercial valuation.
That is a great bit of advice there that you've given. And yeah, it's funny you say about HMOs. I'm noticing a lot of people, everyone's putting a desk in there now, right?
Yeah.
So it makes sense too, because everyone needs to work from home pretty much. And you touched on something that was really important. Funny enough, I think it was Ranjan who told me when he came on the show, and I know you know him extremely well. Yeah. He was saying that about the Article 4 and them having to give you notice. Like you said, you have a whole year potentially when they bring in these things.
Yeah.
They have to give you a year. It doesn't come into effect straight away.
Immediately, correct, yeah.
And last question that just spurred off the back of all of that was, is there a yield multiplier that people can work on or work towards?
Yeah, this comes up quite a bit. Can I get 8 times? Can I get 12 times? My question is, why can't you get 9 times or 11 times? So there is no rule of thumb, and I think it's a bit of a myth, to be honest with you. When I speak to lenders, when I speak to surveyors, they say it's a myth, and they have to. And ultimately, they go by those key areas that I talked about. Is it an Article 4 area? Can it be converted back? And ultimately, the demand for that type of property. If it's in an Article 4 area, that means there's probably lots of HMOs in the area, so there's a good chance that you're going to get it. The income multiples are very much dependent on comparables. I know it's very simple, but it is done on comparables. The demand in the area, how many HMOs are there, and they will get feedback on that. There is no rule of thumb. It's 8 times, 10 times, 12 times, and it comes in the commercial space with retail premises as well. I've got a cap rate of 7 times. How do I get that? My property's worth X. I'm getting this much rent roll. There is no fast fix. Unfortunately, there is no thumb.
So how? I understand that there's not exactly a fast fix. So how does an investor forward plan to know that he needs some sort of metric, right? How does he know it's going to be a deal? Yeah. So where do they start? Do they start by talking to their mortgage specialists? Do they speak to valuers? How does it work?
I think it's a mix of all of that, to be honest with you. I think you need to first of all speak to local agents on the ground in that area. Understand what's the demand like for a HMO. Let's pick on HMOs. What's the demand for those HMOs? How much are each rooms letting for? How long are the tenancies for? How long are the voids for? Is this in an Article 4 area, this street, for example? Then you need to speak to your mortgage broker and understand the value of the property, how much each room's renting for, and then we can work out what the mortgage is going to cost you, what the repayments look like on an interest-only basis, for example. Then you can figure out what the return on investment is. And then you'll be able to look at, well, I'm going to yield 3%, 4%, 10% from this property. So I would just keep it simple. They're the fundamental things. Look at comparables, speak to the local agents, see what the demand is for that type of occupation, that type of tenancy, and then speak to us as mortgage brokers to understand what the cost of borrowing is, to then look at the return on investment.
I think that is a great way to end this show. Akhil, thank you very much for joining us today.
Pleasure.
As people would have noticed, we've barely scratched the surface in what we can discuss and the questions and where we can go with this. If there's one thing I know people can take away, it is absolutely imperative, in my mind, in my opinion, to have a mortgage specialist in your power team. The deals change every time. Lender criteria changes often, as we've touched on, and your individual circumstances will change from time to time.
Yeah.
It makes sense to get help with all your options along the way, make your life easier. Akhil, if people want to find you and learn more about you, where can they go?
Thank you, Raj. The website's ourmortgagebroker.co.uk. There's tons of information on there. We're fully accessible 7 days a week. Telephone, email, give us a shout. We'd love to help you.
Absolutely brilliant. And I hope we get to do it again sometime. Akhil, thank you very much again. And I will speak to you soon.
Pleasure. Thanks for having me, Raj.